Yeah.
Hey, we're live. Surprise, like we are every time.
It doesn't tell us what's happening. It just says scheduled and then boom, live.
Yeah, boom. Well, welcome to the show, everybody. Thanks so much for tuning in to another episode of the Bearded Men of Real Estate Show. This is episode 107.
Wow.
Dun, dun, dun.
That's a lot of episodes that we give to you guys because we love you so much.
Yeah. We're super excited to be here. We have a ton to talk about today. We're going to talk about mortgage delinquencies. We're going to talk about forbearance. We're going to talk about what's happening with the market and the mortgage rates and tons of stuff. So we have a pretty packed show, so we're going to get right into it. Dan, before we do you want to tell everybody what Be More is actually all about?
You know, I would love to. Now, when I met Ray about 3 years ago, actually, it's exactly 3 years ago as of what, 2-3 days ago?
Yeah. We had the friendiversary. Not to make too big a deal out of this, but Ray and I have known each other for 3 years, and we had a video made. That doesn't happen for everyone, but Facebook made us a video. So don't be jealous, but that happened. So just deal with it. But anyway, when I met Ray 3 years ago, I don't have to say about 3 years ago. I get to say 3 years ago. I already had an idea for a show because I am, in fact, a bearded man of real estate. And when I met Ray, I noticed something very interesting about him. I could do this trick.
That, and also, did you guys know he zip lines to work?
Yeah, every day.
Every day. Isn't that a cool? I like to give fun facts about Ray that people may not know.
I call it getting on the line.
Oh, we are full of it today. Hey, so, but what I really noticed about him is that he loves giving value up front to his clients, and so do I. So it's about being more as an agent, but also being more as a human.
There you go. And again, one of the reasons we do this, adding value, it never fails that every week, we do the research for the articles and stuff several days before the show. And it never fails that somebody asks a question and brings up an article that we talk about on the show, just in one of our meetings with clients. So informing the consumers, informing the people, the lay people, is a big reason why we do the show too. But informing you, the agent, so that you can talk to them. Well, are you going to get into the headlines? Hey, wait. I should mention that we try to do this every Wednesday around 12 o'clock. Sometimes it runs a little later when I was messing with lights and all kinds of stuff like that. So we're running just a little bit late today. But I appreciate those of you who are joining us live. We can display your comment, just like Christian Harris says, "What's up, fellas? What's up, Christian? Thanks for joining the show." And then Melissa Mara says, "Hey." And then the Bearded Men of Real Estate Show said, "What's up, everybody?"
Hey, and by the way, I don't know if you guys noticed, but I started a watch party today. I have no idea how that works or what happened.
We'll see.
But I started a watch party.
Yeah. And so right now, I know there are several of you that haven't commented yet because I see how many people are watching the show. We do appreciate the participation. So if you could comment as we get into some of the articles, just like Eric did. Hey, Eric, what's up? Thanks for joining the show, man.
Hey, we love all the views and we love all that stuff, but what we really want is we want the lurkers to turn into commenters. So go ahead, comment down below.
Yo, we have several yos. It's a very, very yo-friendly show.
Well, technically, we have Yo-Yo, Eric and Garrett right there.
We need a YOLO. All right. Are you ready to get into the headlines?
We are murdering it today. I'm ready. I think I'm going first, right, Ray?
Yeah. I'm going to put you up first.
Nice. And you got mortgages in forbearance?
No. That's what I'm saying. You go ahead and do yours. Mortgages in forbearance.
That's what I'm saying.
Yeah. I see what you're saying now. Yeah. I'm with you. In
case you guys don't know, I know we're fooling you right now, but Ray and I are about 2,500 miles apart. So I know you can't tell because watch. Ready? Hey, buddy. How you doing?
Oh, wait. I did it wrong. It's backwards. All right. Anyway.
Yeah. How's it going, Ray?
Hey, I'm good, man. How are you?
You want to do a quick high five?
Let's do it.
See? I know we're fooling you guys. You think we're in the same studio, but we're not. So producing this show live, it always has its fun.
It's terrible.
But hey, mortgages and forbearance declined for the fourth consecutive week. Now, what I did, so I'm going to read through this, and then I actually have, let me make sure I still have it up. I do still have it up. So I went back and found, because we've been covering this since forbearance. And by the way, that's not bears that are coming to the forefront of the economy. That's actually, it's a loan modification thing. So I went back to May, early May, and got some stats. So I'm going to read through this, and then I'm going to go back to what those stats looked like, and we can compare them. It's kind of interesting to me.
Nice.
The total number of mortgages in forbearance declined for the 4th consecutive week, according to the Mortgage Bankers Association, or the MBA. The percentage of Fannie Mae and Freddie Mac loans in forbearance continued to decrease for the 5th consecutive week. So now it's breaking down the individual. Okay. From 6.17% to 6.07%. Now we're dealing with big numbers. So even though the percentages are smaller decreases, this is still a good sign. Ginnie Mae loans in forbearance declined significantly from almost 12% down to 10.5%. Likewise, total loans in forbearance by independent mortgage bank servicers declined slightly from 8.3 to 8.1%. So here's a quote from Mike Frattantoni. He's the senior vice president and chief economist of MBA. I said it right. The share of loans in forbearance continues to decrease as more workers are brought back from temporary layoffs. However, our survey reveals a notable shift in the location of many FHA and VA loans, which have been bought out of Ginnie Mae pools. So essentially, Ginnie Mae is selling off loans, so their forbearance numbers are going down, obviously. These buyouts, he continues, these buyouts enable servicers to stop advancing principal and interest payments and to work with borrowers in the hope that they can begin paying again before they are re-securitized into Ginnie Mae pools. So numbers, yeah, right. So numbers obviously are good, but part of them is just because things are being moved around, right, Ray?
Yeah. Oh, wait, let me get back. I was reading, going in depth, if you will, into the article. Part of me wondering about the mortgage forbearance is if there are fewer loans in forbearance, is that just because some of the loans are running out? And it's not like people are now rescuing themselves, pulling themselves up by the bootstraps and then taking their loan out of forbearance. Their loan is being thrust out of forbearance and into maybe a refi situation or something like that. So it's definitely something to keep an eye on because we see that they're decreasing, but we don't know where they're going.
Exactly. So it's a good sign, but it's a kind of a let's watch what happens, that things are. Yep. So what I did, I found a graph. Now this is from May 10th. And I think we've been covering it since day one, since they announced forbearance was a thing. Yeah. So this is the number of servicing portfolio volumes and forbearance by investor type over time. So there's Ginnie, Fannie, Freddie, and then the PLS portfolios, and then the total. So all the numbers are about the same, but the total at that time of just everything was 8.16. And what are we at right now? The total loans for everything is 8.10. So they went up, but now they've come back. And I like the total number just because it kind of excludes the where are they going, who are they being bought. So I just like the overall number, but it is coming down. And then the other really good point to me, Ray, if people didn't pluck that out of the story, was that servicers are able to refocus away from, letting people, go and not paying, and now helping them in ways to actually pay. So I think that's a good foundational tool to build on.
I wonder if we'll see the number of refis increase during that time period due to all this, because that's a number that should come out next week. I want to get to a couple of the comments. Garrett Woodall said, I met you at the Tom Ferry conference, and since I decided to follow in line with you and Gary Vee and many others, it seems to be a successful thing to do, podcasting and all that. Yeah, I mean, we make oh my goodness, $0 doing this show, but
no,
it's
wait,
a lot of fun.
Wait, no, your assistant ran the new numbers. What was that?
Oh, yeah. Including the t-shirt sales that were a charitable donation. It's $, actually.
Yeah, we've actually lost money.
But we enjoy doing the show. And part of the reason we do the show is to meet people like you, Garrett. So thanks for checking it out. Chris says, have you heard anything on rent forbearance? Maybe on next week's show. We're touching on rent slightly at the end of the show, but not necessarily rental forbearance. But we are going to talk about the rental market and the California crisis that's happening.
Yeah,
I don't know if you knew this, Dan, but your market is in a crisis.
Well, I mean, not the market I work.
Garrett says, "Mind over matter, my friend." That's right. I don't mind the matter.
By the way, you see that the Bearded Men of Real Estate show. It's because we're a highly produced show. We have a team of producers. I do here off camera, and then Ray does as well. So they're commenting for us. So in case you guys couldn't tell.
Yeah. So I guess I should put there. Thank you, Sup Garrett. Thanks for joining us. I should tell the producer that they have a capital H after the T. So
they'll get it. That we also have an editing producer as well.
That's right.
Yeah, we many producers. That's only funny to Ray and I, but we have listeners somewhere in this world, and they're listening to a joke that didn't happen for them.
There you go. All right, so let's talk about mortgage rates. They set yet another record low, but buyers have pulled back. What? Almost doesn't sound like news anymore. Mortgage rates fell, another record low. Total mortgage application volume rose 5.1% last week compared with the previous week, according to the Mortgage Bankers Association seasonally adjusted index. Mortgage demand got a lift from another big drop in mortgage rates. The average contract interest rate, well, I never read that part, so I'm going to skip it. Applications to refinance a home loan, which are most sensitive to weekly rates, moved. It jumped 12% for the week, 107% higher than a year ago. And this is kind of what I was just talking about. I wonder if some of that is people coming out of the forbearance and then refinancing their loan. And that could be why we've seen some increase in that. Let's see. Applications. Oh, wait. The refinance share of the mortgage activity increased to 64.2% of total applications from 60.1% the previous week, which was super high for the year, by the way. Doug Duncan has a quote. He's Fannie Mae's chief economist. He says that the continued decline in mortgage rates pushed up our refinance volume forecast. This forecast towards for the end of the year, up to about $100 billion. At the current mortgage rate, we estimate nearly 60% of all outstanding loan balances have at least half a percentage point incentive to refinance. That means 60% of loans out there have 0.5% incentive to actually go through the refi process. So one of the questions we were asking earlier in the year is this, as all the refinance demand started to slow, we were wondering, does this show signs that those who could refinance are done? And apparently not. Let's talk about demand for home buyers. It did fall 6% for the week, but it was still 16% stronger than a year ago. The annual comparison, though, was half of what it was 2 weeks ago.
So, but okay, forget 2 weeks ago, forget right now, 6% less. Yep. A year ago, when everything was quote unquote normal, we were 16% stronger than that.
Right.
So
Joel Kahn. There you go. NBA's Associate Vice President of Economic and Industry Forecasting. I'll read this quote from him, and then we can kind of move on. He said, purchase activity remains relatively strong despite the continued economic uncertainty and high unemployment caused by the ongoing pandemic. So just a note on the unemployment rate. The unemployment rate is, and this was in my there you go, Dan. And this was in my Susie Orman video that if you haven't checked out, you got to check out the Susie Orman video where I broke down her post piece by piece. And one of the things she talked about were people that were unemployed. But as I looked at the unemployment statistics, last time I checked, it was around 11%. I think yesterday when I checked, it was around 9%.
So it's going down.
In America, we consider full employment anywhere from 4 to 6.4%, depending on the economy. So it's really only about 5% higher than full employment.
And that's at the lower end of the average, 4%.
Right. And we can't assume that those 4 or 5% who are unemployed all own homes.
We also can't assume that they all got fully laid off and that they're not just in, because they
might currently be gainfully unemployed.
Right. That's fine. They're filing for unemployment, not that they are unemployed. They're filing for unemployment. And by the way, I'm sure that a lot of these realtors are part of that have filed.
Yeah.
Technically, they're not without a job. They just need to, they needed supplemental income or whatever. They needed help. So that's part of it as well.
Right. Chris said he was wondering if this is going to scare investors from purchasing and placing renters. I don't know. I mean, you have, so let's talk about the environment that we're currently in before we get to the next article. You have an environment in which most people who want to buy a home and have the means to buy a home can buy a home. You have a ton of buyers in the market. The thing you don't have is inventory. So I think the thing that would keep an investor from making a purchase right now is the high price of the item they're purchasing, and not so much the uncertainty in the market and the forbearance and all that stuff. I think, an investor is probably kind of waiting and looking for that deal to happen where they can maybe catch one that's being foreclosed on. But if I was an investor and I was holding a bunch of real estate assets, I might start offloading a bunch of those assets right now because they're at the market peak. And then I'll wait for the next downturn and then buy some, right? So you sell high, buy low if you're an investor.
Well, just wait until November. Susie says everything's going to be worth half.
Now in California, I don't know if you know this, Dan, but there's a real estate crisis there. There may be some opportunities there for investors to pick up good deals in California. Oh, Chris said he was referring to rent forbearance.
Yeah.
Well, if it's rent forbearance, it still has to eventually be repaid. So the investor will be made whole, in my opinion. I don't think it'll be totally forgiven. There is landlord forbearance that we talked about last week. So landlords are able to get forbearance on some of their loans and also a little bit of relief. So I don't know.
Well, and also remember, it just goes up the food chain. So if the renter can't pay and they go into forbearance, then the owner has to.
Yeah.
So, but it still becomes at some point, unless they own it outright, and it's a wholly owned property, then pretty much is it just the landlord deciding, okay, you're in forbearance right now. Let's revisit this in a couple months. I'll float you. But are they reporting that? So
there's a lot of commercial companies that tried to get forbearance. There are some companies that are closing doors, retail companies that are closing doors because shopping and everything has moved online so rapidly. Very quickly. Where sales are so slow. So I would see the CMBs, which we also talked about last week, the commercial securities, that I think could cause some issues and might create a bunch of opportunity for investors. Melissa said, but as soon as you report the commission received, they cut you off. And she's talking about from unemployment.
Report what?
Jennifer Knott said, Ray, that video is perfect. Great info and well organized. Oh, thank you, Jennifer. She organized it for me. I just rebutted her.
I feel like you need to send these people $20.
Yeah, checks in the mail. The mail.
And I don't. We've talked about it. What's going to happen, but we haven't seen like a report on here's numbers on rentals in forbearance.
Right.
I
don't know how they would report that.
Right.
Other than the landlords applying for forbearance because the renter is in forbearance. Right.
But what about the ones that own the building or own the house outright? They've, it's been in the family forever. They're not going to report anything. They're just going to try.
Yeah, you're right. I don't know what would happen in that situation.
And you can't really evict your lease, your lessee, right? Because they can't pay. You just have to wait until they can pay again.
There are issues right now with evicting. In some areas, they're not allowing it.
Yeah. And and we have covered that on the show.
Right.
Okay. So the next one kind of goes with what we're saying is online shopping is everything adapted. Now, Ray, what do you think before we read this story? And you guys, what do you think? Did realtors adapt quickly to everything that happened? Or do you think, how do they, okay. I have a two-part question, but how do you think they are saying they reacted? Do you think they're handling this well or not?
Oh, realtors are marketers. So I think all realtors are saying they adapted and they haven't missed a beat. And they've been able to use all the emerging technologies as a technology-enabled agent in order to service their customers.
Okay, ready? So strong majority of realtors say market is in recovery phase of pandemic as buyers return. Now, this is 4 or 5 days old. So things have changed here in California the last 4 or 5 days. Things aren't fully shut down, but we got to wear masks again. Indoor operations of certain businesses are shut down again. So
there's a real estate crisis.
Yeah. So after enduring months of setbacks brought on by the Rona, I didn't change it. But a new survey from the National Association of Realtors shows that more than 9 in 10 of its members believe they are in the process of recovering as many states start to reopen their economies. Small towns and rural areas were more likely to report that there had been no pause in buyer activity and were also more likely to report a stronger return of buyers to the market. So that's kind of where I'm at, is buyers were here. They haven't really gone away, but there's way more of them in just personally for our team. While the housing market as a whole was understandably caught off guard by the Rona, the NAR survey found that many members are now prepared should another surge of the Rona occur. So here we go. 39% of those polled said that they are at least somewhat prepared for a second wave of the disease. So after all this, only 39% are really ready. After almost 4 months of this.
How? Maybe they mean like emotionally ready.
Maybe.
Right.
But 19% are reporting that they are, quote unquote, very prepared. So, moreover, of those who believe there might be a resurgence, 30% said they are more prepared now as they know what to expect. 27% indicated that they are concerned enough that they have changed their business practices in some form in order to be prepared for another bout of the Rona. So, and if you want, by the way, this is over at realtor.com. If you want to check out, there's plenty more stats and facts on who thought this and how many percentage of that and how many 9 out of 10 thought this. But
this is .org, isn't it? And this .org? Yeah, it's .org.
Realtor dot what?
Realtor.org, right?
This
is our association. NAR.realtor, yeah.
NAR. Oh, so this is the NAR page and then .realtor. Sorry.
Melissa Marr said quickly, it wasn't an issue working from home, and I was still showing with precautions the entire time.
Really?
Garrett said there was a city sanction in Jonesboro, Arkansas, northeast Arkansas, that expired mid-May that forbade evictions because of non-payment.
So
Brad Daniel said self-awareness is an acquired taste.
Is that this week's shade?
Yes, that's the first shade of the week.
I like it. Brought to you by, I don't know. No one wants to sponsor the show.
Insert your sponsorship here.
It's brought to you by us. So here, I just think it's astounding to me that we've had all this time. First of all, there were a few of us, I mean, us realtors, that were actually preparing for some sort of crash or some sort of change in the market anyway. And then this is what the crash was. This is what happened. The Rona happened, right? So for us, we have our ways in how we went about it, but we were ready to pivot. We were ready before it even happened. And I'm thankful for that. But after all this has happened, we're now 3+ months into this, and only 19% say they're very prepared.
Yeah.
Because another wave's happening right now. So
the second wave, if you will.
Yeah. Or if we were in the 80s, it would be called the new wave.
The new wave. Very good. I feel like there's a real marketing opportunity here for most agents that have prepared and that can now inform their clients. Here's what to do during this second wave. And here's how to manage your real estate. And hey, if you've got to move because, your job in, I don't know, Kansas says that you have to be there, but yet you're locked down where you currently are. And how do you sell your home? How do you do the virtual agent thing? So I think there's a big opportunity for agents just to market as, knowing what to do. If you are one of the 90% who say they know what to do, there's no way so 20% of agents make 80% of the money, right?
Right.
If 90% of the agents knew exactly what to do in this time period, then they'd be making 90% of the money. And that's just not the case.
Not at all.
So there's no way that's accurate.
But there is a part of this.
I love the confidence, though.
The confidence is great. But that's why I asked the question up front. Do you think it's really happening, or are these just, no, it's going good. I'm doing great. I mean, because how many times do you talk to a realtor where they do 5-6 transactions a year and they're like, dude, I'm killing it.
How's the market? Oh, man, the market is awesome. Well, it depends if you're a buyer or seller.
Right. Well, no. Okay. Well, what I meant was, and then you can swan house it.
Nice.
Just another inside joke for Ray and I. So, but those of us who are already prepared and we're able to get our clients and keep our clients comfortable during all this stuff. Now it's up to us, like Ray said, the marketing idea, just get out there ahead of this and say, hey, there might be another wave of this. Don't freak out. We've already had you prepared for this since day one. So
what do you
We got you. By the way, Melissa says her comments are being marked as spam.
Really?
Like literally a top fan. And it,
How is that?
Yeah, I don't know. We're seeing them though, but yeah, she sent me a pic, so it's interesting. Maybe it's because I started a watch party, so who knows?
Oh, there it is. Bearded Men Real Estate Show said, "Don't be so spammy in the comments, please." What are you posting about, Melissa?
That's one of our producers. Guys, dude, chill.
Melissa said, "Don't freak out. We already did this once, people." Yes, that's exactly. As a matter of fact, you can make that your status.
Yeah, there you go.
Don't freak out, guys. We've already done this once. I've been selling all year. You know, I'm ahead year to date of what I was last year.
So, and then I know we're kind of deep diving this, but the other reason I say it is because 9 out of 10 saying that the market has bounced back or whatever. What exactly did they say? Hold on.
90%, yeah.
Believe they are in the process of recovering as many states start to reopen. So, A, I think there's going to be shutdowns coming again. And B, 9 out of 10 seems a little crazy to me. Saying that we're recovering. I just feel like there was a big wave, a big frenzy that happened. And I don't know if that can or will continue, at least here in the markets I'm seeing. I don't know. I'm a little wary of that. And 9 out of 10 seems floofy to me.
How to stay afloat in the second wave. Okay, so let's talk about, speaking of not staying afloat, let's talk about some delinquencies. April delinquency rates soar amid pandemic. This comes to us from Veronica on Inman. She says delinquency rates across the United States soared in April, a change caused by the coronavirus outbreak that experts warn could spell trouble for the months to come.
Wait, didn't I say forbearance was less now?
Forbearance is less, delinquency's up. What's interesting is the comparison of foreclosure, the comparison of the 60 days, 90 days, 90 plus days out. So 6.1%, April marked the first increase in the nation's overall delinquency rate following the 27 consecutive months of year-over-year of declines. So we've had 27 months of declines. April, it spikes to 6.1, and then you can see how many days out people are. The resurgence of COVID infections across the country has created an economic uncertainty and leaves those who are unemployed concerned with their ability to make monthly mortgage payments, or I would say also probably rent payments.
Yes.
Dr. Frank, not theft. No theft.
I think we say nothing.
Nothing. He's a chief economist at CoreLogic. The latest forecast from the CoreLogic Home Price Index predicts prices declining in all states through May of 2021, erasing some equity and increasing foreclosure risk. So this is one of the things. This is one of the things I took on Susie about. If you are in an environment where you see prices start to normalize, you notice I said normalize and not decline. We have been on a ride for a long, long time, and the ride has to eventually start to levelize, start to normalize, and may even decline some in some of the major metropolitan areas. The reason for that decline is not just going to be magic, they're declining. It's going to be either a drop in demand or it's going to be an increase in inventory. If demand drops at the same rate that inventory declines, then prices are going to remain stable. And those are the headlines that you'll see. Price gains slow, right? I mean, that's kind of what we always make fun of.
Which before the Rona happened, it was every week. Price gains are slowing. Price gains are slowing.
Price gains are slowing.
Yeah.
So I don't anticipate a depreciation scenario, but I do anticipate a scenario in which prices should normalize through the last. And I think even before Rona, we were predicting a recession, and we had talked about there were only 2 recessions in history in which home values lost value. The others, they either gained 3 to 6%. So it doesn't make sense that this would be any different, especially with the strength of buyers. You just have a lack of people able to search for a property. So the delinquency issue should be rebounding, but this is what they say about it. Serious delinquencies in which payments are late by more than 90 days and foreclosures in which home is seized due to the owner's inability to pay are still down 1.2% from 1.3% and 0.3% from 0.4. So the number of foreclosures are down, delinquencies are up, but I would anticipate delinquencies being up as long as the unemployment rate is a little high. You're going to see an increase in some delinquencies. You're going to see an increase in landlords not being able to pay the rent if the renter has forbearance and he can't kick the renter out. If that landlord is an accidental landlord and maybe he's laid off too, then you're going to see delinquencies there. But I don't think this is a long-term thing. I think as soon as the Rona is gone, all of that stuff returns to normal because it's not an economic problem. It's a pandemic problem.
Right. And we've been saying that since day one.
Right.
You know, it's not and by the way, I forget who posted the article. I don't know if it was me. It might've been Sean Styles. So thank you guys for being part of the contributors group. If you're not, go look for Be More Contributors, BMORE contributors with an exclamation point, join. We've still only kicked out or denied 3 people. But again, Russian operatives. We found it. We had our producers look into their history. We denied them. So if you're not a Russian operative, you can be part of the group. So thank you for that. And we've been saying
Epstein in there, but it's fine.
A little bit of that. Yeah. But we've been seeing, or saying with all the research and all the numbers we look at is like 3% to maybe 5% because of this. And then the newest article said 6%. So it's still, remember, Ray, what do you always say? A correction is 10%. It's still less than a correction. And there's no way, it's going to be very difficult to get to the 19% drop after 2008. So we won't even see a full correction. And it's more just like a leveling or a normalization, like Ray is saying.
Chris asks, are they still evicting people in Arkansas? As far as I know, they are. However, Arkansas is one of the 13th most employed states in the union right now. So we're not closed down fully, and we're still operating fairly normally. You know, you have to go into restaurants with masks and stuff like that, but we're pretty open.
So your landlord asked, how's your job going? Oh, no, it's great. Everything's great. Okay, cool. Get out.
Oh, you're one of those. I'll tell you what, why don't I skip to the other story, because the next series of stories that we have all kind of go together. So let me go ahead and cover this Redfin one.
Yes.
So Redfin said that over half of the home offers, let me reread that. Over half the home offers were in a bidding war in June.
Yeah. And I'm going to go live, find another article.
So more than half of Redfin offers were part of a bidding war for the second month in a row in June, according to the data from the brokerage. More buyers are entering the market, while more mortgage rates continue to hit record lows. As a result, 53.7% of Redfin offers faced competition last month. That is up from 51.8% in May and 44.4% in April. Here's the quote from them. They said, bidding wars continue to be fueled by historically low mortgage rates, fewer homes up for sale than most any other time in the last 2 decades, said Redfin economist Taylor Marr in a written statement. Let me see if there's any other, let's see. No, they kind of break down like multifamily, single family, different areas. That's it. So basically there's a bunch of bidding wars that are happening, which you're an active real estate agent. You probably already know that.
Everything. And I did find the article. It's the Inman one that I
Eric
shared.
Vasquez on our last note, he said New York is on hold for foreclosure filings and tenant evictions until mid-late August. Well, if there's a second wave, I wonder if that would be extended too.
Yeah,
Yeah. Did you find the other one?
It was Inman saying the same thing, but I mean,
Gotcha.
I don't know what you guys are experiencing, but I've had a couple instances where I've not gone up against other offers, and it's very, very simple. It's even though there's frenzy right now, because pretty much every other offer I've written in the last month and a half, Chris and I were tracking my stats specifically over the last 45 days. It's been insane. But pretty much every offer I've written, I've had to compete with multiple offers. And by multiple offers, I mean at least 6 to 7. In some instances, it was 19, 23. I mean, we're going back to 2004 status here. But wow. in the I'm going to say 2, maybe 3 rare instances where I offered and they didn't have any offers. It came down to one thing, Ryan. What do you think that is? Actually, I'm going to say 2 things.
Your rapport with the agent.
But what made them not get any offers?
Oh,
in a crazy market.
You would have had to go in with a really solid offer first, right? So that they don't wait.
There's that. Although smart agents are making their clients wait through weekends now, so you do get multiple offers.
Maybe they came on too high.
So it comes down to price. Everyone, all 2 or 3 of them that we went in with they had no other offers. They had been sitting on the market. And by the way, sitting on the market means 19 days right now, by the way, for me. Wow. That's sitting on the market. Like, what's wrong with that house? Why has it been on the market for almost 3 weeks?
Yeah. I'm going to show houses this afternoon in a city that has a median days on market of 7. That means half of the homes sell faster than 7 and half of them sell more than 7. That's crazy.
That's crazy. So yeah, it came down to price and their marketing, their pictures there. And then I would also add into it. Now, this isn't like a nationally known stat, but to me, ease of accessibility.
Yeah.
How easy did that realtor make it for other realtors to get into that house?
Realtor. Melissa Morris said, I think the latest one I had was 12 offers competing. Eric said I was up against about 5 other offers recently, used the escalation clause with premium terms, went $13K over.
Ooh, escalation clause. Hey, have you ever used that? That is a brilliant. Yeah. If you ever want to be tricky and sneaky in your offer, use the escalation clause. It is so good.
It's legit. If
your clients are up for it, obviously. And we're getting super realtor right now, but sorry, consumers.
We're getting deep.
Yeah. Yeah. Right. And remember, Eric is kind of rural where he's at. So 5 offers is quite a bit.
Brett says price and condition. Eric says it was the only way we could get it.
Boom. Nice
so this
work.
Next story may be of interest to Chris, who's been asking a lot about kind of multifamily structures and what's happening. So a lot of you know that since COVID, there's been a huge change in Silicon Valley, how they operate and what's going on. So there's some imagination now. Or I've been watching the Disney documentary. So I just want to say Imagineering all the time now. So there's been some Imagineering going on around the change of multifamily, what it might look like in the future. So what's that, Dan?
Yeah, and then this one. So on its website, there's a company called Juno. I think we've covered them before, but I don't recall. But Juno says it wants to reimagineering, quote unquote, the cities of tomorrow. Okay. The company, which just moved out of stealth mode last week, which I didn't know that was a thing for companies, is in the development business and will specifically focus on building multifamily housing. So they're not only, and this is it's a little different because they are tech based. They're going to come up with a new app and make it seamless and blah, 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 like every other quote we see. But they're also actually going to focus on physically building these things. Mm-hmm. It aims to create a new type of apartment building for the future of the American city. And now this is from Inman, if you guys want to go see it. Juno is not the first company to attempt to shake up of the multifamily housing industry, but its emergence highlights the way that Silicon Valley is increasingly moving not only into real estate generally, but into the thus far traditional practice of moving dirt. So actually building. The company says that one of the problems with those kinds of projects so far is that the marketplace has produced generic and mediocre developments no matter where they're located. So let me go. So essentially what they're saying is it's the same thing over and over and over again. You take and I believe what they're calling their smaller units is 100 to 200 units in these rental units. And they're saying if you're in Albuquerque, New Mexico, if you're in Little Rock, Arkansas, if you're in Northern California, it's the same 100 to 200 building just plopped into a different spot. And he's kind of saying that the CEO of Juno is kind of saying that it's the same thing for people to look at. And they're kind of like, well, I've seen that 1,000 times. I want something new. So their focus is to change it up. Now, the co-founders include a former Tesla executive and the dude who designed the glass Apple stores. Remember those?
Ooh.
So if you guys have been to New York City, I think it's on Fifth Ave, Fifth and what, I don't remember. It's above the Met. I know that, but New York has a when you go, it's a fully glass Apple store and then that's just the top of it. And then underground is the actual store. It's amazing. It's really cool. So what are they going to do? That's the question I want to ask here is, my joke was, are they going to just build completely clear glass, like invisible jet apartment buildings? Or like, what are they doing here? What are they going to do that's so different? So there is one that's right by Angel Stadium. By the way, baseball comes back in a couple weeks. Kind of 60 games, and they haven't had a preseason. So
they have a ghost man on for a
time. Yeah. Hey, that guy bunted. Put him on first. Let's imagine the guy's on first. But yeah, there you go. So Eric says it's the old FAO Shorts location across from the Plaza Hotel. But they put like a glass encasing with a Apple logo, and then you go down into it. It's really, really cool. So anyway, but
so it's all about like sustainability, right? I mean, that's kind of the play, is a sustainable play. Like Tesla was a play using batteries for stuff, sustainable.
Using batteries. And then also, I think it's just the base idea is just something different. So now there's and I would guess that it's about 200. It's a really cool looking building, and it's called the George. So you already give it a cool name, and it's in Anaheim, California, not a crazy, well-known like high-end city. But it's literally Angel Stadium parking lot and then the George. But it offers everything you could want, including a full-on bar upstairs, like with the fire, with the view, with the big screen TV, parties, DJs, the whole thing. So is that where they're going? More of that?
So more modern, luxury, upscale, sustainable.
Yeah. And the article does talk about actual supplies and actual building materials too. And then my question is going to be, what is it going to be the cost of all this? Is it cooler? So it's going to, like Tesla's, they kind of come at a premium.
We have a lot of upscale apartment buildings here in Little Rock for such a small city.
I have a brand new one right by me, and it's really cool looking.
They do really well here in it too. I don't know. So I know it's going to be sustainable. I know they're going to look at kind of different designs and architecture, but it sounds to me like you remember when all the tech companies in Silicon Valley tried to have like the best workspace, and like, hey, you go to work for Google,
exactly,
and you can have a nap room, and you can have a
ping pong and
studio, and ping pongs and all that stuff. I feel like this is people realizing that people don't want to go to work and hang out; they want to go home and hang out. So maybe we should make home a cooler place.
So maybe is this going to be a combo of the WeWork model where you can go sit in a cubby hole and work, but you're at home working with your working.
We'll have all kinds of different cool spaces in the apartment complex to use for different things.
Yeah. So it's comboing 2 or 3 different areas. Maybe that's it.
I feel like that's going to be the movement. I don't think that's a very sustainable movement. Just based on the numbers, right? You have to make up for every common area you create are rooms that can't be rented.
Right.
So then you disperse what you could be renting divided by the rest of the community and increase the price. And that's only going to happen when people have to have rentals. But Dan, that brings us to the next article. Tech companies are ending leases and consolidating offices as remote work is here to stay. So I think this is the play. I think this is the play for both that who we just talked about, and then what's going to happen in the future. They have to now recreate this cool tech company community environment now at home using the cool apartment complexes and stuff, because tech companies are packing up shop.
Well, and what if so Juno comes out with this cool apartment with this cool WeWork space in it. What if they, instead of passing that cost on to all the renters or all the lessees, are they lessees or lessors?
Local tech company?
They get a local tech company or tech companies to pay for that, and then their employees work there and live there, and then the rent is paid for on both levels.
You know, what we could do is have these factories that have the rooms and bedrooms and stuff attached to the factory. That way people just never have to leave work. They just wake up, eat, sleep, drink, and just...
That's how cities used to be built. Where Colin J.J. Cameron lives, his city is built around paper mills.
And communist China.
Well, That's built in. Have you ever known it's built in rings? Did you know that?
I didn't know that. I gotta check.
Yeah,
this.
they have status rings. So if you live in the inner ring, you're this, outer ring, and so on. Yeah, it's interesting. But all these cities were built because they would come in and they'd build the factory, and then people would just live right there. But then, at least here in California, all of a sudden it became this. Not all of a sudden, but now it's this. I can't afford that, so I'm going to buy an hour away, and I got to drive, and I'm miserable. But I bought a house.
Well, now the work for home stuff is here to stay, which could be leading to the California real estate crisis. Dan, did you know you're in a California real estate crisis?
We are right now.
So tech companies are ending leases and consolidating offices for remote work. It is here to stay. Let me put this article there. All right, there you go. So here's a group of employees that are leaving, I guess. I don't know what that is. On a Saturday in April, several executives from Sound Commerce rented a U-Haul and drove it to their office in Seattle and loaded up the truck with stand-up desk and 48-inch monitors and other gadgets and personal belongings. I'm just thinking about what that looks like as they like
Me too.
into these like very new offices and everything that are all open work environments, and all they have to remove are desk. Like you don't have to change any walls, you don't have to do anything. You just basically remove your desk and your stuff, and you're done.
Yeah. There you go. Here's my desk. And I'm picturing the actual like, and I'm not trying to be offensive here, but the nerdy like CEO guys like, well, we got to move this stuff into a like big.
Somebody have a screwdriver? I don't know how to screw this.
Yeah.
Okay, keep going here. Okay, so they said we polled the team, and the vast majority they prefer to remain at home. Of course. We're not making a decision for the long term right now. We're thinking about what to do for the next 12 months and in terms of maximum security, maximum safety of team, and maximum flexibility of the company. So the article goes on. You can find this article at CNBC. There's Aaron Levy. He said it's becoming increasingly evident that businesses in the U.S. will be working at least heavily remotely for the better part of this year. There's no longer temporary work patterns or IT strategies. We're now in it for the long haul. So I thought that was an interesting quote on the Twitters.
Is anyone else concerned the people in that picture are not socially distanced?
They're not socially distanced at all. I was meaning to, there's that quote from Aaron Levy. As you can see, the argument is pretty much everyone is doing it. So, and we've come a long way in technology. We're using things like Slack and Workplace and all those other things, right? So,
well, and Zoom meetings now are just normal.
Melissa Marr says, all right, guys, I have to go pay the man at the post office. Happy delayed tax day. Oh, yeah, today is the delayed tax day. Tom Butt said, haha, newfangled company town. Yeah, that's what we were talking about with the, wake up, eat, sleep, drink, and you stay in one spot.
Yeah, but I would honestly love that. I mean, well, that's kind of what I do already, but I mean, I think it would be a great idea. And by the way, when Juno adopts what we did and adapts to what we just said, we're going to want our cut.
So my question for Chris is, how is this going to change the rental in that market? How is this going to change rentals and what landlords are thinking, and what, the company with 100-unit complex that's obviously got to be a luxury complex, sustainable, et cetera. Does that change their plans if people no longer want to live in a city center? We're getting a lot of people from California who, actually, I don't know if you know this, Dan, but California's in a real estate crisis.
We're in a crisis right now.
We're getting a lot of people from California moving to Arkansas right now. And they're making inquiries and they're looking at homes and they're like, oh, wow, if I can buy that in Arkansas, I can buy two.
I know. We're selling all their houses. Sending them right to Ray.
You're going to be in a real estate crisis soon.
Yeah. So what if the next addition to your question is, now what if I was looking for a space to rent for my employees? A bunch of them already worked there, and then the cost is going to be offset because there's already a bunch of people paying rent around it. So I can get this cool space in this cool new building with a bar on top and some dancing and a DJ, and all my employees can be happy and work there, and I'm going to pay less for rent.
The Bearded Men in Real Estate Show says, Chris, isn't this the bigger issue? ? That's a good point.
Well, we're in a housing crisis, so Chris may have had to go work.
That's right.
He's out here in Moval right by me.
Okay, so we have two more articles, and then I want you to address this one, Dan, since you are in the heat, in the middle of the California housing crisis. Number one, I want you to tell me what it is because I didn't know you were in a housing. Did you know you were in a housing crisis first off?
I did not know that.
Okay. So number one, I want you to tell me what it is. And number two, I want you to tell me why Apple needs to give how much?
Total $2.5 billion.
Yeah, what are they doing? What's going
Okay,
on?
so now the crisis that Ray keeps referring to, I think the producers are pushing him to refer to this, is the affordability crisis. And that is an issue. Now, they're talking mainly Silicon Valley and where all the tech companies are, and we talked about it 2-3 shows ago, where rent in San Francisco has gone down for a 1-bedroom apartment from $3,800 down to $3,200. It's still too much. But essentially, because these high paid, as we think through things, right? I'm going to get to the story in a second, right? Hold on. Bring yourself back up, will you?
I'll bring myself back up.
Hey.
Hey.
So as they've essentially created a crisis because all these high paid employees in these tech industries that need to be close to work, they're buying up all the houses and driving the prices up, right?
Right.
Now, what about people moving out of those areas? Won't that bring prices down and help us settle a little bit? So it's not a bad thing. So, okay,
let me say this is kind of exactly why the articles are stacked in this order today.
Right. Okay. So what do you know? I'm doing what the producers told me to do. So Apple said on Monday that it is partnering with the Housing Trust Silicon Valley and the California Housing Finance Agency. It's part of a total $2.5 billion that Apple says it will spend on the initiative over several years. So if you want to see the full breakdown, go to CNBC. Homes in many parts of California are too expensive for low-income and middle-income buyers, which has created a housing affordability crisis in the state, which I've been saying for the entirety of the show, so 3 years now. The problem is particularly acute in Silicon Valley, where Apple is located. Okay, start thinking. As highly paid tech workers are able to pay more for limited housing stock, driving prices up. This has been well documented on the show. So some of Apple's $400 million will be used to create a fund that aids first-time low-income and mid-income buyers. It will also be used to create new affordable housing units in California, including more than 250 units of affordable housing across the Bay Area, Apple said. Some of those units will be reserved for people with developmental disabilities, the homeless, formerly homeless, and veterans. So this is a great thing. And there you go. There's the breakdown. So $1 billion is earmarked for California affordable housing. $1 billion will be spent to assist first-time homebuyers. $300 million will be used to build affordable housing. $150 million to be invested in Bay Area Housing Fund. $50 million spent to fight homelessness in Silicon Valley. So, by the way, I did do some research on homelessness across the country, and we're at, I think it's just under 600,000 people are homeless, 66,000 in California. So now you go to LA and Silicon Valley, and that number is going to be even higher because things are just not affordable. So A, Ray, is this going to help anything? And B, aren't they just trying to fix a problem that they created?
Well, here's a hot take from the Bearded Men of Real Estate show. He said, housing crisis in California equals affordability crisis, aka home price gains are higher than ever for sellers.
Hot take. Nice work, producers.
So it's going to depend on exactly how you read the stats and then what side of the coin you're on. For sellers, they can.
Well, who are you reading the stats for?
Right. For sellers, you can sell the house and make more money than ever before. For someone that is maybe a service worker in the area, you're going to have to move out of the area. Like you can't live in this area. You're going to have to commute into this area to be a service worker. Right.
But it's also not a new thing.
No, that's been going on forever. But with the ebb and flow of the work from home culture, and then people realizing how expensive it is to live in those areas and then wanting to move out, it seems like it's about to ebb the other direction, which if that happens, it's a great time for Apple to be investing in real estate.
With their own money that they're pledging to help the cause.
Oh yeah. That's right. It's a cause. Mm-hmm.
I just find it interesting that yes, they've exacerbated this situation. And not just them, obviously all the tech companies that come in and go, hey, I'm a new hot product, give us a bunch of money as a startup. And then these guys that are part of, they make all the money, they buy a house, and then their company flops. But they still bought the house. But then their company goes nowhere, like all the ones we've talked about on the show. So
now they can sell it. Now they can sell it at max market value.
Yeah, and I love which is even more than when they bought it too high 3 years ago. So I've said it 1,000 times, and it is a little controversial, but I would love a correction, and I wouldn't even mind 10% in a lot of areas. Some areas don't need it. I mean, a lot of the areas I'm working right now, things are super duper affordable and right where they should be. They're getting a little pushed up right now because of the frenzy, but in the 250 to 450 range, things are very affordable, and that's under FHA limits. You can have a modest down payment, relatively little out of your pocket for closing costs. Like you can really buy these homes. You're not as close to a big city, which I think less and less people care right now. I have one client, we just opened escrow, and they're moving from, you guys obviously don't know Southern California, but there's a city called Covina, and it's LA. So it's already more expensive. They're moving essentially 75 miles away to buy a house for $320,000, $340,000. And it's a house they could never get. It would be probably $650,000 were in the city that they're moving from.
Here's a question. If you build a lot of affordable housing in a particular area of the city, does it devalue property around it?
That's not how our new construction works. Our new construction is always a premium.
That's interesting. So even if it's new construction, affordable housing, it'll only be affordable for a short time. And then once it gets resold and stuff, it's going to go way up again.
Well, it's just that. So if affordable housing is $250,000, new construction would be $280,000.
Interesting.
So there's still the different level of builds, but nothing comes in and like says, hey, this nice house in this area, which is going for 400, we're building new construction, exact same house, even nicer for 280.
So you're assuming affordable housing is single family. How much of that did they say that they were going to do single family? Let me check that here.
It's zero. Isn't it all multifamily?
I don't know. If it is all multifamily, so in our area, whenever you have multifamily affordable housing, the property values of everything around that goes down. And the neighborhoods fight it. They're like, we don't want affordable housing is great. We don't want it near us. That's what everyone says.
Now, by multifamily, do you mean like
apartments?
Right. Okay, there we go.
Apartments, condos, that kind of thing. That's more affordable, quote unquote, affordable housing. It says more than 250 units of affordable housing. It doesn't say single family in there.
Yeah, and what I'm seeing for the rental is it goes back to that other story. They're building these nice high-end things in areas that can maybe afford it.
On Apple-owned property.
Oh, and it's on Apple-owned property.
This is what I'm saying. As the market starts to go down, it's a pretty good time to invest in real estate.
So they're just ahead of the curve. And it's a win-win either way.
And they probably get grants and government grants and helps and matches and stuff for making it affordable. But then eventually they sell the complex.
And what if they're taking advantage of opportunity zones?
Could very well be.
Huh.
Yeah, somebody needs to look deeper into that, I think. I think there's more to that story if we had a journalist in our midst who could maybe. By
the way, that'll eventually be Ray and I. We're just, at least me, I'm going to eventually just become a journalist. This stuff is so fun for me.
I'm an Apple fanboy, so, it's fine.
Well, no, see, you're my inside. No. My good friend is an Apple guy. I'm not doing this to expose anything. He loves Apple, which means I love Apple. But I do have some questions for you.
Speaking of exposure, do you want to get into this next article? This next one's kind of weird. It's kind of heady.
I have a question. This is totally off topic, but when people do these documentaries, so I'm watching this documentary. It's called The Drug Business or The Business of Drugs. It's on Netflix. It's really good. But this lady, speaking of investigative journalism, she's with drug lords and kingpins and like literally on like as their what do they call it? What do they call it when they take the drugs from city to city?
Trafficking.
when they're trafficking it, she's with them. Doesn't that give away stuff? I mean, they're wearing masks, so it doesn't give away what they're doing. Like, how does that work?
That's a good point.
She just walks up and goes, "Hey, can I see your entire operation from beginning to end?" Yeah, sure. And film it.
Totally.
Yeah.
We'd love to share with you our drug cartel.
So anyway, that's going to be my focus as I get into Apple and I infiltrate their systems. I'm going to film it all. So anyway, that's just a funny side note. It's just weird to me. But anyway, which is the next one?
I'm going to cover it pretty quickly because it's interesting, and when we are almost out of time, so I'm not going to spend too much time on it. But quick,
I wanted to add another one as well, just kind of how we did last week. When was it last week or 2 weeks ago when we talked about,
the mentions that we had?
Yeah, I want to do a mention at the end here, but yeah, this one's very heady and can go a lot of different ways.
So Quicken and NAR ask HUD to withdraw the proposed amendments to Fair Housing Act. So there's been some Fair Housing Act amendments proposed. Let me see if I can find the actual amendment. The amendment that I found was actually in the Inman article, which we're gonna go.
You have both. I have both up if you want.
There you go. I'm gonna put the Inman article up. This news came to us first from Housing Wire, but then I saw it also recalled on Inman. The rule aims to give tenants the power to sue landlords for businesses for housing discrimination in instances where discrimination occurs unintentionally.
But now that's not what they're proposing to. That's not the proposal. That's what they're proposing to change.
That's what they're proposing to change. So right now,
it's called that right there.
In place, it's called the disparate impact rule. Right there.
Yeah, disparate impact rule.
Where do we go? There we are. Okay, yeah, the disparate impact rule. So the rule aims to give tenants the power to sue landlords for housing discrimination in instances where discrimination occurs unintentionally.
Yeah, you need to look that up if you're a realtor. You need to look up disparate impact rule. So please look that up. You need to know about it because you may be discriminating unintentionally. And that's what this whole thing is aimed at. And it was created in 2013.
Yeah. So
this isn't a new thing.
No, it was created in 2013. The more I read about the rule, the more I actually found myself on the other side. Because it's like, hey, by the way, did you know you discriminate against all these people? And you're like, what? How?
Well, it's very similar to, remember when Facebook made their changes, you have to do this, you have to do that because you're discriminating against people. And we're like, no, we weren't. We were doing everything that NAR says we have to do, but now Facebook is telling us that we are.
Right. I think ultimately the issue is optics.
How it looks
right now in the current environment. I mean, if we get down to brass tacks. But
that's also why they're saying to maybe not review this, right?
Well, it was reviewed. It was already reviewed, and they already said, okay, we're going to get rid of this. It said HUD proposed an update to the rule in August 2019.
Yeah, so a year ago. And now they're going, but it wasn't passed to pass it.
It wasn't passed, but I mean, NAR knew about this. All the lending institutions knew about this. The only reason why they're coming out against it now is the current optics. But it's very interesting. I mean, I could see someone being on both sides of this argument at the same time, which I kind of am. Like,
totally. That's why I'm saying
fairly, but at the same time, I don't want somebody to be held liable for discriminating against somebody when they had no idea whether they were even discriminating against somebody just because of circumstances and not because of intent. I think that's so gray that it's interesting. So
when we're living in a world right now, I think someone posted a story. What was that one? I should go find that one too. Because we live in a world right now is you're guilty until you're proven innocent. So if you do an ad on Facebook, someone gets mad and you just said, hey, here's my new listing.
Right.
Someone gets mad about it and files a complaint. You're fired before they even look into it. And all I did was say, hey, here's my new listing in Hemet, but I didn't market it to 16 miles outside of Hemet. You know what I mean? Like,
yeah.
So you need to go look at this disparate just so you know what's going on and why they want to change it. And then I think Ray's right. I think you can be on both sides of this fence and understand because it's a very broad stroke thing.
Yeah.
There
needs to be a better rule in place than what's currently there that's more definitive.
Right.
But
so they're not saying get rid of it because it's we don't want discrimination, or we do want discrimination. They're saying we need to adjust it because it's such a broad stroke.
Right. So they have a new rule that they're proposing that's not, I mean, it looks fine. Looks better. At least you have to have intent. But anyway, go take a look at that stuff so that you're aware of it. Dan, what was the last thing you wanted to cover?
Well, there's two now. What's the one you posted?
Susie Orman?
No, someone got fired for something.
Oh yeah, that guy. So that was in the Be More Contributors group. We briefly talked about a guy that got fired for holding an open house.
That one
that had clients who had COVID. But
here you go. Ex Compass agent held showings. This is the one I wanted to mention. So yes, we're on the same page, Ray.
Yeah. Go ahead and define it for folks.
So this is from Inman. So the title is Ex Compass agent held showings at home of COVID-19 infected couple. That's what the title reads. So they're saying that this guy, and I don't want to say his name, but the name is in the article if you want to go see it.
Oh, we're going to say his name.
But Compass parted ways.
His opinion on this thing.
Yeah. Tag in Gary Watt. Company parted ways with him for allegedly holding showings and failing to follow local guidelines. Allegedly. Okay. So now, as I read down here, let's see.
That is.
So
screen too.
Oh, you do. Okay. So a Compass, according to a Compass spokesperson, Watt was aware the household had contracted the virus, but failed to disclose the infections to prospective buyers who visited the home. And that sounds horrible, right? I get it. I understand it. We have a form. I think they're here in California. Yeah, Altadena, California, which is literally butts up against Pasadena, California. Everyone knows Pasadena, right? So it's the city that it's north of it and wraps around it kind of thing. So the safeties, and I agree with all this, the safety of the communities we represent is paramount importance, as spokesperson said. We swiftly parted ways with this agent when it was discovered he failed to adhere to local guidelines regarding COVID. Okay.
That's probably that's probably the issue, is that he didn't adhere to the guidelines.
Yes.
So that's their excuse.
Okay, but so let's see. The
guidelines are like to, wear masks and stuff like that.
Yeah, we have it lays it out. We have a form called the PEAD form, PEAD form, that we have to send. Our sellers have to sign it. Our buyers have to sign it before seeing houses. And it just says, here's what you need to do. It's not they're guidelines, and they're not required, by the way. So here's the other part.
Relinquish liability from the agent is what that form is.
Yes. And here, let me go. I need to find it. Where's Ray again? What are we doing?
That form is not a protection for the consumer. That form is a
and also it's because it says
for the agent.
You'll see in a lot of showings, send the PEAD form and send your pre-approval. These are recommendations. These are not requirements. We don't have to send this. It's just, it's obviously I'm going to send it. I want everyone to be safe. I want everything to be disclosed, and all that. I get it. But these are not requirements. We don't have to do this in California. Right. So, but here's, Ray, can you scroll down? So where it says a public Facebook post in a local community group for Altadena, California, a suburb of Los Angeles, where where did you go?
I don't know where it is. I'm looking for it.
Oh, you went past it. Hold on. Let me just go find it myself. You scroll back up again. Where the home is listed, first disclosed on June 23 that the sellers had tested positive for COVID-19. Again, all of these things leading up to right now that I've read says they did 100% test positive, and this agent didn't disclose it. Okay, now ready. Here's the post. Hi, folks. If any of you attended the open house at 3278 Loris over the weekend, please be aware that I'm told both residents are COVID-19 positive, one in the hospital, the post reads. I had a conversation with one of them on Sunday, and she did not disclose it to me and was not wearing a mask. I'll be in quarantine for the next 14 days. So she talked to these people. They didn't say anything about having it, but then she heard that they were and didn't say anything about it. And now this dude doesn't have a job.
Yeah, that's interesting.
So all of this is about
a Compass source clarified that there was never an open house. All right, so this is where it gets weird.
So here goes another step.
It's like so convoluted.
I know this is supposed to be a quick one, but a Compass source clarified that there was never an open house for the property, just showings by appointment, which is what we're supposed to do. The source said Watt failed to disclose to the individuals viewing 3-bedroom single bungalow that sellers had tested positive. But did they?
And there was no open house.
And there was no open house.
That's so weird.
So
somebody's posting this on Facebook, and the optics
right
are, well, we got to get rid of the guy.
And by the way, did he already have a PED form for all this? Were all these people sending PED forms? Because the PED form says, if you have any symptoms, please don't come see the house. It says that in there. It's fully disclosed.
Melissa Mars says she's back, so we can continue the show now.
So, well, thank you. We've been waiting.
Brad Daniels
look at that. So
he was fired because of gossip. Yeah.
And by the way, he declined a statement. So that kind of leads me to believe that maybe he did do something wrong. But because if I didn't do it, I'd be like,
his attorney said, nah, don't talk to the media.
Yeah. But honestly, like without hearing, I don't know. It's just, it all comes down to that one Facebook post that says, I'm told.
Yeah. And if you attended the open house, and it's not even the open house. So I don't know.
It wasn't an open house. So it's all based on this one Susie Orman I'm still mad at Susie. It's all based on this one post that wasn't completely factual on a lot of levels.
Yep.
But we live in a time where optics rule the world. Here, hold on. I got
comment. I don't want for the optics.
Yeah, we got to watch our optics. Turns out I don't care about optics. I'm just an ethical person, and that's how I live my life. So
Melissa Mars says it's all a lie, basically.
Yeah, but
it's weird.
So he was fired because of gossip.
Yep. All right. Well, on that note, I feel like doing the what's the top gear on that disappointing note.
Yeah. And on that incredible disappointment. And the best one ever is when, they go through, I don't know if you guys watch that, but Richard Hammond, get into a situation and then to be like, oh, he died. And on that disappointment, we must end.
That disappointment.
Yeah. I think they do it on the Grand Tour.
Yeah.
So yeah. Hey, Ray, shirts.
Yeah.
They were ordered.
What'd you say?
The shirts were ordered.
Oh yeah, they were ordered. So if you ordered them, if you ordered a shirt, they have been ordered. I haven't charged you yet because I haven't been charged yet. So once I get charged, you guys are gonna get charged. So hang in there.
Yeah, I'm watching optics right now. I'm gonna be careful.
Yeah, we have good shirts. Listen,
great shirts. Super excited. Hey Ray, where can they find you?
Ray Zorback. That's RayZorback. And Danielle, where can they find you?
It's Danielle Ludwig Rocks. That's IELLE. D Ludwig Rocks everywhere. DLUDWIGROCKS. Everywhere.
Boop, boop. Yeah, Melissa Mars said, I got that email from your assistant and got excited. Whoop. That's when they were ordered. So I'm just waiting on them to charge me. I'm like, guys, you're going to charge me? And they're like, yes, we're processing. So I think our t-shirt people are behind a little bit, but they'll get it.
Hey, and by the way, can we just give her a shout out? She's the one creating those. So we have those new
thumbnails,
those little cards before every show.
Yeah.
Can we give her a shout out? She's creating those every week. So every week, Ray and I
good job.
Pose and send something, and then she cuts it out and puts us up there. So let's give her a quick shout out.
Good. Let me see. I was going to share it here. It's taking forever to load. Here's one that she did. There you go. That was for this show.
It's so good.
We're fans of ourselves.
Wait, maybe we just do this for us. All right. Hey, love you, buddy. Love you guys.
All right. Bye, everybody. Woo!
Bye.